So now is the time to be going out there, talking to other people and be really excited about what's coming, and just tell them frankly, like, listen, I don't know exactly when this is going to happen, but I can guarantee you it's going to happen within the next 3 to 5 years. And I want to be ready for it. And I want you to be ready with me. And this is what we're going to do. And go talk to those loan officers as well. Get all those ducks in a row. So listen, you may not be able to like leave your W-2 tomorrow to pursue this because the deals aren't there. But if you start planting the seeds now, start getting some capital saved up of your own on the side, start talking to other investors, you are going to be one of the people who changes the trajectory of your entire family.
Well, it must be official. JP Morgan now says that a real estate super cycle is on the cusp of happening. We're going to talk about what JP Morgan says is going to happen. We're going to talk about what Jonathan and I both believe is going to happen. And frankly, we called it early and we will be right. But we're going to start with, why does everybody think it is not coming? Or frankly, that JP Morgan, Jonathan, and I are wrong and we won't have a real estate super cycle. Jonathan, you and I have been talking about this coming wave, this coming opportunity for years now. We called it early and I think we have been right. But there's still a lot of people that go, nope, you guys are wrong. It's not happening. I don't see it, so it can't be happening.
Well, listen, it's a good thing that JP Morgan has been watching this show. And they finally learned something about how real estate works. Because you and I have been saying this for a long time, and now these Johnny-come-latelys are clearly, they're
jumping on the bandwagon.
They're jumping on the bandwagon, on the one rental at a time bandwagon. But anyhow, yeah. So why do people not think it's happening? Well, just as before the peak, before the cycle stopped, before the music stopped, and you and I were calling for a crash, there were many, many people saying, well, it hasn't happened yet, so you're wrong. As if, things just, we declare interest rates should be lower and they magically become lower just like that. It just doesn't happen that way. These things are it's like a slow moving battleship. It takes a long time for these battleships to turn or stop or whatever, but you can see what's coming ahead. Like just while you're in the battleship, you can see those rocks up ahead and you're going to hit them, but you've got people on there saying, oh, it's fine. We haven't hit them yet. Nothing, no worries. Right?
I love that analogy, but it's even worse. You and I were on the ship with other people. We were looking at the rocks coming. We saw the captain was drunk off his ass, sitting on a lawn chair talking to some lady, and there was nobody in the thing. And we're like, dude, we are getting out of here. This is not going to end well. But everybody was still playing and like, oh, there's no problem. You and I are, on this other little boat getting away. So
yeah, our captain was the guy who ran the ship into the bridge pier in Baltimore, right? So
yeah, whatever, man.
We saw it coming. Well, okay, all right. Enough joking aside. So listen, so the thing is happening in slow motion. And what we've had is, there has been no pressure yet applied to sellers to sell their properties at a loss. And because of that, now there's a bunch of things that are happening as a result. Because of that, the market is just gummed up, right? Buyers are no longer willing to overpay for property on the hopes of future appreciation because they're looking at rent growth, it's way down. They're looking at supply, it's way up. They're looking at interest rates, they're way up. You cannot buy on a hope and a prayer the way that you used to. They want to buy on real numbers with a margin of safety. Now that's not possible because the sellers are stuck with their pie in the sky numbers that they should have gotten if they had sold 2 years ago, or they're underwater and they're trying to figure out how to get, back even and at least get their capital out or avoid a foreclosure. And so the market is just kind of stuck. Now it's going to stay stuck. And so because it's stuck, a lot of people are like, well, there's no crash, right? Mm-hmm. Crash isn't happening. We'll just all sort of work our way out of it. It'll be a slow slog, but we'll all be fine in the end. But what is going to happen, and you and I have talked about this before, it just hasn't happened yet, is that lenders will eventually run out of patience. They will just decide, or the lenders will be forced by their own lenders. In the case of private equity, they will just have to get out what capital they can so they can move on and reinvest it in something better. right? And once that happens, once people throw in the towel, then what you're going to see is a rush for the exits.
Yes.
Just like you had predicted, and just like what happened in the great financial crisis. This time is different is not an investable strategy. You see this happening time and time again. It just takes time. So in the great financial crisis, the bottom, and I'm talking about commercial, right? So the commercial market didn't bottom out till about 2013. Right? So it's five years after the peak.
And,
right?
And you know what's really interesting is again, I think everybody thinks the stuff collapsed together. As a buyer throughout that cycle, single family, aka residential, impacted first. The banks gave up first. There was no equity first. And frankly, in my market, residential was starting to heal as soon as 2010, 11. Mm-hmm. But at that exact time that residential was healing, then commercial started to collapse because this duration, this extend and pretend, this hope and a prayer, they finally gave up. So we were buying residential from like 2009 to 11. And then we were buying commercial 12, 13, 14, right? It's like, guys, this, it's not, first off, it's not the same. The people that say residential and commercial are the same are idiots who've never done a deal.
Yeah. They're related, but they're in different phases. They're not
Correct.
tracking directly at the same time, right? So you'll see a similar wave pattern, but the commercial, they're out of sync with each other, right? So
correct.
So that's kind of the way, because the capital markets are drawing ultimately on the same capital markets, but there's a different analysis going into them. And the commercial property market is just way less liquid than the residential property market because you don't have a lot of, commercial buyers who have to buy, right? They may want to buy, they may need to buy to make money, but they don't have to buy. Right. Unlike, homeowners who really have to buy, they move, they whatever, or emotionally they're locked into buying, right? There's a lot of reasons other than probably most of the reasons that they're buying are not financial. And so it's a very different thought process that goes into the
again, the other differences are, let's just talk about the difference between residential and commercial. First and foremost, the dollar value, right? A commercial loan is likely going to be, 4 or 5x bigger than a residential. There's going to be less of them. The equity positions will be different. And let's not forget that the borrowers also are a lot more sophisticated, typically, meaning they got a bunch of lawyers, right, that they can delay and all of that. So, the setup is just different. And you're absolutely right. The way functions may be similar, but they're so not in sync.
Yeah.
Right. And that's how I was able to time getting out of resi when it's high and, commercial when it's low. And I'm calling my shot. I'm going to try to do it again in 26, right? And sell when resi's high and commercial's low.
Yeah. And it's coming in commercial. And, so I was mentioning before we started that I did a post on LinkedIn yesterday about why lower interest rates are not going to help the commercial market. It's not that they won't, it's not like they won't help it, but they're not going to solve the problem.
Not going to save the day.
And then in response to that, someone posted a really interesting analysis that his company had done, which suggests that commercial property has about another 20%. He's talking about multifamily, has about another 20% to fall based on the spread, the historical mean spread over the last 15 years between the federal funds rate and cap rates on multifamily. And traditionally, or at least over the last 15 years, so that includes the crash and the run up, it's about 3.3%. So 330 basis points, more or less, of spread. Right now, the spread is 170 basis points.
Wow.
So basically that suggests that it's got to double, right, to get back to the mean. And now some of that could happen if interest rates come down, but are they going to come down that much? They're going to come down. Is the federal funds rate going to come down 170 basis points?
No,
probably not. So maybe there's some combination of maybe the federal funds rate comes down a little bit, but the cap rate still has to expand to get back to the long-term median. And, it's just reversion to the mean. So there's a way to go before the capital starts coming out and then just sort of I know you want to respond to that, but just
Yeah.
like, just the other thing to consider about this is that, I've been hearing this talk since 2018, since the market started getting really frothy, since like 2018 or 2019, when a bunch of syndicators out there, won't name names of people you and I both know, who were talking about, everyone was starting to say, hey, look, this has gone on a long time. There's going to be a correction, right? Or interest rates have been low for a long time. They're going to go up, more likely to go up than not, right?
Yeah.
At this point, even
Couldn't
though
go lower.
then COVID happened, right? But, if COVID didn't happen, right, it would have been right. And so, but these people started coming out saying, well, there's all this dry powder on the sidelines, and it's all going to rush in and support the price of multifamily. And what those people failed to understand, and when I pointed this out to them, they usually mocked me, right, was that capital was on the sidelines for a reason. It was waiting.
It's patient capital.
It's patient capital waiting for huge discounts, right? It was sitting there growing and growing and growing, so that when those guys overpaid and then their multifamily dropped by 50%, those guys were going to come in and buy it from them for pennies on the dollar. That's what it was waiting for. It wasn't waiting for a 5 or 10% discount.
No.
Now that capital is all still on the sidelines, and it's actually going away. I was reading the other day that capital is being siphoned off to other things. It's not waiting around for multifamily anymore. It's like going into whatever it's going into, treasury bills or whatever, because it's just, it can earn money.
You
there.
get 5% in a 10-year treasury or whatever.
And so, and all those funds that had raised all this money, they've had to give it back because the opportunities aren't there. So that now it's just because they're early, though. Those opportunities are going to come, but they're not going to come for another couple of years, most likely, until this extend and pretend runs its course and the lenders just throw in the towel. Okay. So now you wanted to respond to that.
Yeah. Well, I think this, I'd love to read that analysis, the 20%. I agree with it. I think I've said over the last month or two that Class A multifamily is starting to retrade and unlock at about a 25 to 30% discount, which is a net good thing, but it's also a signal that Class B and Class C need bigger discounts.
Exactly.
Right? People don't understand that if you can get a Class A for a 30% discount, Class B at a minimum is 40 or 45, and Class C is north of 50.
Yeah.
Those things are gummed up and not moving, but it will eventually.
And yes, and here's the thing too. I'm glad you brought this point up, because one of the things that happened when money had no cost was that, so usually you have a risk premium between Class A, Class B, and Class C. And you also have a risk premium between A markets, B markets, and C markets.
Yes, in tertiary.
So you can actually draw yourself a 9-place grid, right? With up in the upper left, you've got, A property in A markets, and you've got A property, B markets, C markets, and then you've got, and then the different classes, right? So you have A property in A market up here, and you got C property and C markets down here. And there is going to be basically, like, by the time you get, there's a 3 percentage point or so cap rate spread between AA and CC, right?
Exactly.
And what happened when money lost its had no price, that whole thing shrunk like this. So that there was cap rate compression along the whole grid, so that basically you had maybe between an AA deal and a CC deal, you had maybe 1 point of cap rate differential. Maybe. Right? Yeah. And then you had people going and overpaying for those because they were saying, well, we're going to do, because cap rates are so low, we're going to do a value add. And even if you don't move them up the value chain, if you just raise the rents, then, well, you will create all this value. And that's fine as long as you don't have any cap rate decompression for any reason. But as we've seen, cap rate decompression can happen from either interest rates going up, which happened, or rents declining, which happened, or NOI shrinking, which happened, right? So all those things happened. Now what you see is the slow unraveling of that process, and people don't see it happening because basically everything is frozen in amber for a while, right? Until, as we said, until the banks start to just throw in the towel and call in those loans and foreclose them. But what you are seeing is that there are transactions for A properties going on right now, but nobody wants to touch B or C at all, right?
Exactly.
So
there's the
those
buyer and seller agreement is just a huge gap.
So those losses have not been realized yet. That's the thing, right?
Correct.
It's like on the books, they still are being marked as whatever they were bought for years ago. The losses have not been realized because nobody wants to touch it, right? I mean, you could look at it another way. So the value is zero. If nobody wants to buy it, it doesn't have any value at all, right? But on the books, it has whatever value it had because you haven't realized the loss. Now, you will get back to that point where you've got that cap rate spread that compensates you for the additional risk you're taking on a C deal in a tertiary market. And once that happens, there's going to be great buying opportunities. And if you know how to run those properties, you're going to be able to buy them cheap and make a lot of money, but it just hasn't happened yet. Be patient.
This is the real estate super cycle that JP Morgan is now highlighting. It's something that you and I have been talking about for years. One of the things I do want to talk about is a lot of people still don't see it. A lot of people have experience from the Great Recession, the GFC, and they think it's going to be the same. To which I say it's going to be the same and completely different.
So what do you mean?
Right. So it'll be completely different because the asset's different. It's not coming to residential, right? You're not going to see streets across you're not going to have 4 million homes listed. You're not going to have, 400,000 new listings a week just because the debt structure is different. It's the debt that blew up, folks.
Yeah.
In 2006, 50%, I think it was 51, I'll say 50% of loans originated in 06 were ARMs. So guess what? 08, they started blowing up.
I mean, this is like, it's so nutty that so they fixed the debt problem in single family, right? They didn't let people take out these stupid loans that they did. And now we're not going to have the crash, right? But what happened? They started issuing the same stupid loans for multifamily.
Yeah,
right.
They did.
And folks, it's always the debt that kills you. It is always the debt. If you buy a deal for cash and you don't have any debt, you can basically ride out whatever happens. You go down to 60% occupancy, you're fine. It's not going to be fun, but you're not losing the property, right? The problem is the debt. And what happens in every single cycle, it happened with single family the last time around, and now it happened with multifamily. Somebody somewhere decides that this is safe, can't lose.
Can't lose.
And then they start issuing funky debt because you can't lose. And then the funky debt drives the price up even higher. Then to make the return, people take on more debt and more debt. They start, they did after the GFC cap the amount of debt you could get on multifamily to basically 75%. However, they didn't stop people from raising pref equity, which I hope next time that's what we're going to see. I hope we're going to see the lenders be like, no pref equity, nothing like that. But, they started raising pref equity, which frankly, if you were an LP and you were behind that pref equity, probably pref equity is wiped out of most of these deals, but you're taking the first dollar loss. Most of those people didn't understand it, but it allowed people to overpay because they believe like this is going to go on forever, right? So it's always the debt that gets you, and debt comes in. They start making debt. We were talking about this back in the day. They couldn't get the proceeds, but what did they do? Everything went to interest only, right? It's almost the same thing, right?
Yeah,
Non-amortizing debt. Effectively, it's like getting more leverage, right? That allows you to pay even more. You're overpaying for the property. And every time you overpay for the property, you just increase your risk on it. So, there's a lot to unwind here, folks. It's going to take some time.
Yeah. So again, it's not the same because it's a different asset class, different zeros, but it is exactly the same for everything you just mentioned. The debt structure is wrong, funky lending, can't miss, all of these things. And it's back to your boat analogy. This is what we saw coming, and we got out of the way, right? We sold some assets, both of us. And, then COVID happened and it got really nutty. And I still remember the presentation we did 2 years ago where we built a spreadsheet in real time where we turned $100 million building into 48 million.
Yeah. Not hard.
That's happening.
It's happening.
Not hard.
Yeah. It's definitely happened in the commercial space for sure already, right? Because that's been high profile and people have seen that. Now, the super cycles actually probably started in commercial already, right?
Because, it has. That's his point, JP Morgan's point.
Yeah, because people have thrown in the towel on office.
Yep.
Right. And now you're seeing huge discounts.
I've seen some over 90%.
Oh yeah, I know. It's incredible. And those people are going to make money because they're buying them at such cheap, prices. And this is why basis means everything. If you buy it at a 90% discount, you can have the place 20% full and make money.
Dude,
right?
you could. This is the plan. There was a office building on a river. I wish I had the article. It was in the Real Deal. You can go look it up on the Real Deal. But it was a massive rectangle, like probably 5 or 6 stories high. They bought it for the value of the steel.
Wow.
So they're going to knock it down, sell the steel, and then they're going to scrape the lot and sell it to some multifamily builder.
Wow. That's a smart play. That's
Exactly.
Really, that's so smart. Yeah.
Why not? Oh, you're going to give me, I'm getting the recycled value of the steel. Wow. Yeah, I think I can do that.
Wow. That is incredible. I love that deal.
Again, it's an ugly office building. It's out of date. It's 100% not occupied, but somebody's got to own it. So somebody comes in. I think they got it for 92% off the last sale price. The article talked about it being the recycled value of the steel. So they're going to probably spend a year taking it apart safely. Yep. They're going to scrape it, sell the lot to a multifamily builder, and bingo, bango, you got multifamily on a river. There we go.
Yep. And that land will be valuable without that building.
Exactly.
Right? So,
without it there.
And listen, when we talk about all the office to multifamily conversion, and it's going to happen, folks. I mean, there was all this discussion about, it can't happen because it can happen. The only thing that prevents it from happening is the price. But the price is going to fall to the level that it'll make it feasible. So for those old, Class C office buildings, they talk about the floor plates are too deep and all this kind of stuff. What? It doesn't matter. They will, if that thing drops to 10, it gets sold for 10% of the last sale price. Believe me, they can leave all, they can leave all that space in the middle empty, or they can convert it into self-storage. They can put a gym in there. They can do all kinds of non-rentable things, and it won't matter because the perimeter with the windows will be valuable enough that they'll be able to make plenty of money on those buildings.
Exactly. They can literally leave them empty, right?
Yes.
Just wall them off.
Yeah, exactly. So, but they will find uses for, frankly, storage is probably the way to go. Every single apartment could have its own storage locker that they pay extra for. That's a no-brainer, right? So
this is why JP Morgan says the super cycle is coming. It's why you and I say it's coming. Again, it's not here today, right? For every asset in every city, but it is coming. Even in my little market of the Central Valley of California, I saw people paying 4, 5 caps for stuff that I wouldn't have bought for a 9 cap.
No,
that stuff is coming due, and I hope to pick it. And again, if you read my book, One Rental at a Time, I have been through this cycle before. I have bought directly from banks. I've bought directly from a bank president who said, "Hey, can you take mine too?" It's coming.
Yeah. And listen, if you are watching the show and you're thinking like, man, it's tough to do deals right now. And it is. If you're in commercial like I am, it is not easy to do deals right now. Right. So but I'll tell you what you should be doing, because this will bottom out and you want to be ready for it to bottom out. Right. So now is the time to be going out there, talking to other people and be really excited about what's coming, and just tell them frankly, like, listen, I don't know exactly when this is going to happen, but I can guarantee you it's going to happen within the next 3 to 5 years. And I want to be ready for it. And I want you to be ready with me. And this is what we're going to do. And go talk to those loan officers as well. Get all those ducks in a row. So listen, you may not be able to leave your W-2 tomorrow to pursue this because the deals aren't there. But if you start planting the seeds now, start getting some capital saved up of your own on the side, start talking to other investors, you are going to be one of the people who changes the trajectory of your entire family.
Oh, perhaps for generations.
Well, that's what I mean. Yeah, for generations by getting in at the bottom of this, right? So start thinking strategically about this really hard, because you do not want to miss this opportunity.
Yeah. And again, and frankly, it has to come.
Yeah.
And again, I want to make a connection, because again, one of the things I hear a lot about today is, there's the bankruptcy cycle is picking up, right, in small business. We had a 2 or 3 year period where money was free. And frankly, there should have been businesses that went out 2 years ago that didn't, because money was cheap. Now the bankruptcies look higher because we didn't have some for a couple of years. It's going to take time, but it has to happen. They were bad. They were stupid. There were unprofitable deals done that eventually will come to the market, and they will be sold at, again, I'm telling people 50% off. Class B and Class C could see 50%. If Class A is 25, Class C could be 50.
Yeah. And just for some context too, I want to I meant to mention this before, just for context. So in the great financial crisis, the crisis in commercial was really overshadowed by what happened in residential, right? So
Yes.
a lot of people
missed it.
Yeah, a lot of people. I remember there were a few years where people were saying there was no crisis in commercial, and that was because they just weren't paying attention, right? And also they were focused on what happened after the crash, once the foreclosure crisis happened, and all those people moved into apartments and apartment rent shot up. That's what they were focusing on, to say, oh, multifamily didn't have a correction, but it did. It corrected by about 33 to 35%. And the interesting thing is that actually made multifamily the strongest performing commercial asset
for years,
because it only lost 33 to 35% of its value. Now that's on average, right? So that means that your Class A in a Class A market probably lost 10 to 15% of its value, but your Class C in a tertiary market, I mean, whoo boy, if you didn't have a really low basis in that property, you were in some really deep doo-doo. So, and that's going to happen again because the prices were even higher. There wasn't a bubble. That's the thing. There wasn't a bubble in commercial the last time around.
There wasn't funky debt. It was real debt. It was like, hey, 70% LTV.
Yeah. There wasn't a bubble in multifamily like there was this time around. So we did not have historic low cap rates in the run up to the GFC.
Absolutely right. Yeah.
Cap rates were like 8. I mean, it's crazy. People, you look back at the data, it's like insane. People, it's, at the height of the bubble, multifamily was trading at 8 caps, right?
Yeah.
And now at the height of this bubble, this past bubble, a lot of it was trading at sub 4 caps.
Oh.
Right? You want to buy like Dallas multifamily trading, and I'm not even talking about A stuff. I'm talking about like 30-year-old value add multifamily trading at
80s build
at under 4. Under 4.
That doesn't make sense. It never made sense.
And you think that there's no reckoning coming for that? Let's just even assume that it doesn't go all the way back to 8. It goes to 6.
That's
still all the equity is wiped out and you're underwater and you're getting foreclosed on.
It has to happen. It's coming.
Yeah.
It's coming. Yeah. So again, JP Morgan, thank you for jumping in the bandwagon. The real estate super cycle is going to be amazing. It's just not here yet. It will come eventually. The other thing I do want to close on this, the other thing that'll be interesting is when the dam breaks, and it will eventually break, it'll be very interesting to watch who's the first mover. Because again, something that happened in the last cycle in resi that will happen in commercial today is the first person who breaks actually wins. They take the smallest discount. And then the dominoes fall and it gets bloody after that.
Yeah. I mean, what do you think about like the banks? I mean, I'm thinking like we're going to have another like S&L type crisis, or, it's going to be really bad because
there will be hundreds of banks that are forced to, merge with stronger banks, hundreds, because again, this is going to be very much a regional. This won't impact JP Morgan. It won't impact Bank of America, but all those commercial banks that are very city market dependent, there's going to be a lot of pain.
Yeah. And then look, and here's another thing that's going to sort of depress prices further is that next time around, those folks are not going to be so eager to lend, right? Or it's going to take them a long time to get around to lending on commercial property again. So a lot of these, a lot of these deals are going to get foreclosed on, and you're not going to be able to get debt to buy them.
That is exactly what I was going to say. You know why the residential market collapsed so bad is because the banks exited the market.
Yeah.
Right. I had to go from paying 6% interest at a bank to paying 12% interest. Well, guess what? I had to buy it for cheaper.
This is what's already happening in multifamily too. You see all these debt funds springing up, and these debt funds are not lending at 7%, right? Which would already cause the prices to drop considerably over when people were getting sub 4% mortgages, they're lending at 12%, 15%. So what do you think is going to happen to the price of these assets, right? They're going to plummet. So
no bueno, no good.
Get cash. Get cash.
Yes, stat cash, people, stat cash. Again, and just to be very clear, what I'm going to do is explained in my book, One Rental at a Time. I will be 1031ing out of residential real estate into multifamily with no cash. I won't be putting any cash to work. I'll just be putting equity to work. Then I will hold on for a couple of years, which will probably be no fun as you turn buildings around and invest capital. And then on the other side, when it all comes back, life will be good.
Yep.
Jonathan, where can people follow you and get all of your information on what you're doing in school?
Well, follow me on LinkedIn and be part of the conversation there. After my social media break, I'm back. So come join me there. If you are looking to learn, go to my school group where I coach on all this stuff. I don't know what to say. It's a great program. It will teach you everything you need to know. You get to talk with me directly, ask me questions about anything, coach you through deals. It's great. So come join me there.
Awesome. Thanks, buddy.